Get paid to wait. That's the philosophy behind the abrdn Global Dynamic Dividend Fund we are going to talk about now here in Munich. Welcome, Ross McSkimming, Senior Investment Specialist from abrdn. Nice to have you here.
Thank you.
First of all, please, can you describe the GDD fund?
GDD, Global Dynamic Dividend Fund. Well, first and foremost, it's a global equity fund which is there to deliver a premium income. Now, the way that we operate is to invest in between 80 and 100 stocks. There's 90 in there today. And we look to invest in these for the longer term. But it's a two-pronged approach. We have the 95% of the fund is invested in buy and hold, where we are holding stocks for the longer term. That will pay some income, but it will also pay for capital appreciation as well. But we also have 5% in the dividend capture sleeve, and that's the important bit. That, to me, is like the turbocharger. And that is there to really deliver on that premium yield that we are looking to offer. So getting paid to wait really means that you are being paid a regular and premium dividend, round about 5 to 7% yield, but you're also waiting as you get the capital appreciation as well. And this is a really competitive product for us. We are managing round about 1.4 billion in the strategy, and it's been super competitive.
Let's talk about the dividends, Ross. What is the point of dividend capture sleeve and how does it fit into the design and objectives of the fund?
Yeah, that's a great question. And it's important to remember that we invest in two prongs in this particular strategy. We have the dividend capture sleeve, which makes up round about 5% of the portfolio, and round about 95% of the portfolio is invested in core holdings. And typically these core holdings, we're investing for the long term, we're investing in different sectors, we're investing in different countries, and they're broadly balanced between value and growth. But it's the 5%, it's the dividend capture sleeve that I find really exciting. It's almost like the turbocharger to the overall investment. It's looking to enhance the yield of the overall strategy, and it tactically rotates in round about 40 to 80 dividend capture events each year. These can either be regular dividends or they can be special dividends as well. And on average, when I looked at 2021, we did 40 dividend capture trades last year. And on average, that was round about a 10% yield on each and every one of these. And so that's really there to enhance the yield of the strategy. Now, we know that some of our competitors do different things. Some of our competitors will only invest in high-yielding stocks, but that gives you a lot of factor exposure. Others may invest in derivatives to enhance a yield. And that, to us, it increases the complexity of the products. We don't want to do that. The original design of the strategy was to be very simplistic, to rotate in and out of these dividend capture trades in order to enhance the yield.
But Ross, let us know, how does such a small capture sleeve generate so much dividend yields?
Yeah, you're right. And it's a question we get asked, why don't we make that capture sleeve any bigger? Now, we always want to maintain sustainability of the dividend yield. And we believe that a yield of between 5 and 7% is sustainable, and we can achieve that using a 5% capture sleeve. And that 5%, so what happens is, of the overall portfolio, around about 5% of that portfolio is invested in dividend capture trades. And as I mentioned, these are regular dividends or special dividends. So special dividends can come around, for example, if a company has got a lazy balance sheet, there's lots of cash on the balance sheet, or perhaps they've gone through some sort of corporate restructure. And so then we are looking to participate in these regular and special dividend events. And we've got very good knowledge of these, and typically we will trade in and out of these. Now, these can last anywhere between just a few days, or they can last a few weeks, depending on the nature and the level of conviction that we have in that particular dividend capture trade. But it's all about trying to ensure that we are investing at the right time, getting into the stock at the right time, capturing the dividend, then exiting at the right time. And that period, as I say, can be just a few days or it can be a few weeks. But overall, we have demonstrated year on year our effectiveness at being able to capture these trades without impacting the overall friction or incurring any frictional costs. So we have delivered a very strong yield, anywhere between 5 and 7%. We've been doing this for 10 years now, and we've been able to do that, provide that yield, as well as delivering outperformance as well. So we're getting that, you're getting paid to wait. We are paying that income, but we're also delivering on the performance, that capital growth.
And the last question, Ross, if you invest in GDD, what can investors expect?
What we can do with a strategy like this, investors, they either want to have income, so they might want to have a regular payment. And ultimately what we're looking to provide for our investors is a regular income payment. And we look to deliver, on average, around about 5.25 cents on the dollar. And we want to pay that consistently. So we capture a lot of these trades and we will equalize and normalize these throughout the year. So then we are consistently paying that regular income out to our investors. And that's what investors are looking for when they're wanting to invest in a strategy like this. They want that consistency of payment. So that process of normalization and equalization means that you're getting that regular dividend stream coming through. Equally, some investors just like the style of investing. They might not need the income, so they can reinvest that. So on a total return basis, this strategy looks really attractive and very competitive as well. So ultimately, what we're looking to provide is a very simplistic product, investing in the equities of companies, where we're able to deliver a very premium yield, as I say, between 5 and 7%. At the moment, the yield is around about 7.25% on the CCAV today. And that is something that we find that our clients are looking for, and we think that as an asset class it stands up. You know, it gives investors something different to invest in, gives them some diversification from the traditional sources that they may have when they're looking for income.
And the summary is, get paid to wait.
Get paid to wait. I like that strapline.
Thank you, Ross McSkimming.
Thank you very much. Very nice to see you.